Okay, so today what we're going to be going through is a few things related to the investment memo that I just made. It had everything to do with the Strait of Hormuz, the effect that currently the rate hike scenario is going to be playing on global financial markets as well as the treasury yields, the effect that if inflation does head lower, what is that going to lead to in terms of the effect that it has on equity prices globally, on rate sensitive stocks. So let me give you a brief of how I think about interest rates, bond yields, effects of Fed rate hikes, effects of Fed rate easing, and what exactly do I mean by that. Okay, so this is our new website, which talks about our partnership firm, which is Double 11 Capital. It's an investment partnership firm. You can go through it. I will put the link in the video description. Everything's out here. You have a few of our holdings that we speak about. Now, we may or may not hold them at the time of making this video, but if you can head down here, you should see something called as our thinking, which is basically a letters and memos section where we will be sending out some of our investment memos possibly once every few weeks when we have something to talk about. If you head over here and go into the read memo section, you should be able to see the memo that was written basically yesterday. So you see it here, you can click on it and it opens up into this. Anyways, so let's get to the most important part, which is the Strait of Hormuz. So about 3 months ago, like you can see here, the United States and Iran, alongside Israel, they entered into, let's call it a war, a military conflict or an operation. And that technically lasted for about 40 days. Around April 8th, 2026, you did see a ceasefire taking place. Now, this is a period of 40 days that began on February 28th, ended on April 8th. The markets bottomed somewhere around the end of March and have since been heading higher. Now, while a large part of this move has been related to semiconductor stocks and AI stocks itself, which has caused the S&P to move up, remember, America has a large portion of technology, and within the AI space, the AMDs and NVIDIAs of the world account for a large part of the S&P. The NVIDIA alone would account for more than 5% of the S&P 500 move. Now, when NVIDIA in itself has also not been part of the larger wave of AI moves, but everyone and anything around it and associated with NVIDIA has possibly seen stocks go up 50% and sometimes even maybe about 300, 400%. And in some cases, like SanDisk, the one that we'll check out later, has technically gone up maybe more than 10 times. So my point is not to look for those kind of setups. My point is more importantly to look at what the market is thinking 3 to 30 months out and how do we position ourselves accordingly. Now, you can have a brief read of this. Again, I'll link this as well for you, but we'll go back and forth between these few charts as well as this memo. Basically, this video is kind of a way for me to explain to you what exactly do I believe is going to be taking place. So, long story short, while the market did head higher, you did see the price of oil also continuing to move higher. So let me give you an example here. You look at oil. This is somewhere around the 25th, 28th of February. We were at about $65. We've seen a one-way ride all the way up to 104. Now, what I'm looking at is WTI. So before all of you say, no, we saw 120, that's on Brent, and different exchanges trade differently. But when I'm looking at WTI, 65 headed all the way up to 104, 105. And at its peak in intraday, we were at about 102, as you can see here. From then, we've seen these moves heading lower. So around, if you see 8th of April, which is where we had a ceasefire, that was about 102. And then we've been heading lower to 85. And now we've been heading back. One thing to note is even though we moved back from 83 to 105, the S&P has continued rallying, if you see that same move, right? So what I'm trying to explain to you is that even though you've seen the move on oil head higher, you've seen the S&P continue higher, which is not what happened when the war broke out. The reason for that is a lot of people are not expecting that the war would continue, which as of till today has happened, and there has been small skirmishes here and there, but it's not related to a complete all-out war all over again. Again, that could happen, and that would then cause oil to maybe break its 120, head higher, inflation to head higher. The 10-year bond yield would pick up again. And if that does pick up, you will see inflation expectations pick up and rate hikes come through, and stock markets would get clobbered, right? You will see a bear market go through, something exactly like what happened in 2022. Now, one of the few things that I've been mentioning here is to look at something called as the financial sector. Remember, these are one of the most important sectors in America after technology. So if you go in here and actually type XLF, you are able to see what the financial sector has done. So let's do a small little check here. If you go ahead and see on the 28th of February, we were somewhere around $52, right? So that means the financials were trading at 52. Post the war breaking out, the market cracked and it went down all the way to 47. After the ceasefire that took place, which is around the April 8th period here, you did see financials move back, but they have not taken back their previous highs, which were at 56, 57. While the S&P 500 has moved higher, the financial stocks have not. The reason why financial stocks have not is because of one simple reason, that as the oil price has gone up, inflation has picked up globally. If inflation has picked up, the chances of the Fed cutting rates or any global central bank cutting rates has diminished, and you are seeing an increase in chances of a rate hike. The only way the Fed can make sure that inflation does not get out of control is by increasing rates. By increasing rates, what do I mean? Home loans increase, car loans increase, interest rates on most products increase. And when that happens, the consumer is tightened, because of which you enter sort of a recessionary period. And if that does come through, you will see stock prices head lower. Because of which financials, which are banks who make their income, something called as a NIM, which is net interest margin, what a bank makes is purely on the percentage rate that it lends out versus the percentage that it makes on you keeping the savings account. So if you're getting 4% for a savings account and it's lending it at 8, it's able to keep that net interest margin of 4%. If the Fed increases rates, the bank's margin gets squeezed. So from a 4%, it might become a 3%, a 3.5, and maybe even 2. It depends on how much the Fed increases rates and how the 10-year bond yield works. In that case, the financials are the worst hit. So these are the most rate sensitive stocks, right? You have the JP Morgan Chase, Goldman Sachs, some of these payment companies, as well as a few of these buy now, pay later, Visa, MasterCard, a lot of them that come in within the same financial sector, but not necessarily just a Visa or a MasterCard. It's purely banks and payment stocks that are there. And if you look at this kind of a move, it has not even taken out its previous high, which was even made when the war broke out. Forget about taking out the high which was made here at 56, which was at the start of the year. So is that opportunity or is that the market lagging? That is the obviously multi-million-dollar question that comes up. So let me give you a brief. If you do go down and check out something called as the CME group, they do have something which is related to what the Fed would be doing in the upcoming meeting. So if you see, this is called a FedWatch tool. The current meeting that's going to be coming up is on 17th of June. On 17th of June, the current scenario, the probabilities, if you work with here, it is related to no change, right? Because we're too soon, right? It's just one particular CPI print, PPI print, inflation print that we've got. So it's more than likely that the Fed is not going to be acting on just one single inflation print. You need to see multiple inflation prints in order to see any kind of change. So if you go down here, you see there's less than a 2% chance of a hike, and there's about a 98% chance of no change, which is not a hike, not a rate cut. We stay within the same band of 350 to 375. And as you may have seen, somewhere around April, that number was 93.8, and today we're sitting at about 98%. Anyways, this is not the most important one, but this is just for me to give you. Let's go into the next meeting, and these are where things start get interesting. So on the 29th of July, the Fed meets again. You now are able to see that the 90% plus that we had there still stays at about 90%. So what the market is currently saying is that the Fed might look through even the July meeting. And there's a 10% chance of a hike. But look at something that's interesting here. The hike, meaning the current rate is 350 to 375. And if you want a 25 basis point hike, you would move to 375 to 4%. In that case, you would move from a 0.9% chance, which was there 1 month back, where no one was expecting a rate hike, to today a 10% chance. For anyone asking a question saying a day back on 22nd May, it was a 17% chance. That's because over the weekend, we've had a scenario where there could be a memorandum of understanding between US and Iran. And if that does take place, there is going to be a possibility of inflation heading lower. And if inflation heads lower, obviously the chances of a rate hike also drop, right? So remember, this is a real time that I'm showing it to you. So it all depends on what the big men decide globally, right? Let's go to the next meeting. You're looking at 16th September 2026. Now, this is where you have a few inflation reports. Remember, we get inflation reports every month. So you're looking at May, June, July, August, and now in the September meeting, you would have had almost 3 to 4 reports to go through. Out here, you go down and see, we were earlier looking at a possibility of 25% chance of a rate cut. Remember, we're at 350 to 375. And if we were looking at 25% a month back, today we're looking at 0. So what does that come back to? It comes back to the situation that if there was a possibility of rate cuts of 25%, today we're at 0. And similarly, if there was a rate hike scenario of 0 a month back, now there's a rate hike scenario of 26%, which means the chances of a rate hike have increased by 25%, and the chances of a rate cut, which was there a month back, has dropped to 0, which is why you're seeing the XLF, which is the financial sector, pretty much languish there and not able to move back to its previous high. Let's move a bit ahead and things get more interesting. 28th of October, right? It's a long time from now. But look at something that's happened here. 68% chance that a month back we had the same rate and no cut. 27% chance of a rate cut, which is today 0. 68% chance of no change is today a 60% chance, while a 0% chance of a rate hike has moved to 33%. What the market's expecting is that in starting October, there are chances that we would be having rate hikes. I'm not saying we would. What I'm saying is that it's being discounted. Now, this discounting mechanism is what causes rate-sensitive stocks, cyclical stocks, to take a beating. Remember, the market does not care about what will happen or what is going to happen. What it cares about is the perception of how things play out. Stocks do not react to news items that are known in the future. It is the current scenario that works and how the probabilities play out, and that is how the stock will react and preempt the move. So the current move that you're seeing in XLF and all of these moves here, where if you see, you are seeing this all the way down, even though the S&P is up 18% year to date, the financial sector is down 8% year to date. The reason for that is because exactly these kind of moves that you're seeing here, where a lot of them have now pricing in from no rate cut or even the rate staying steady to chances that rate hikes are coming through. Let's go to the last one because this is maybe the most important one. 9th December 2026, right? Probabilities of no change 43% and probabilities of a rate hike 56.1%. What that means is in December, the market currently is pricing in the fact that we would have a rate hike. Would that be a 25 basis point rate hike or a 50 basis point rate hike? Not sure, but at the moment, the chances are of a 25 basis point rate hike. Let me show this to you. 61% chance that we stick at our current rate is now at 43.9. But what was 31% chance of a rate cut, as you can see here, is now 0. While at the same time, look at this, 375 to 4%, which is 3.75 to 4. Remember, currently we're at 3.5 to 3.75. You can remove the 0 if it makes sense for you and just add a decimal in between the two numbers, which are not 0. So 3.75 to 4 had a 0% chance here. Now it's a 40% chance. And some market participants are also ready to accept the fact that from a 0% chance of a 50 basis point rate hike, we might have to bring it and say that that 50 basis point chance would bring us to 13.4%. So we've moved in about a month back to new highs on the stock market, but it has come at the price of rate hikes and not at the price of rate cuts. It has come at the price of an economy that may deteriorate. And in order to fight that, because inflation would be picking up, economy would be heading lower, the Fed would have to hike rates. Now that is seen here in this whole game here. If you look at the S&P, it's heading to new highs. It does not have as much financial sector moves as much as the tech sector does. So you look at the Nasdaq's also hitting new highs. This move that you've seen on the Nasdaq from the lows is about 28% from its lows. The financial sector in America from its lows is up 8%. That 20% difference is the cost of these rate hikes, right? Now, let's get back to what the whole story here is, that if you do have these, and you can read a lot of this information that I've written out here as well. So it's available here. You can go ahead and read it. But here's the situation that happens with the Strait of Hormuz. If in case the Americans and the Iranians come to some form of a memorandum of understanding, which I believe they will, but don't take my word for it because I don't know. But I believe that they will come to some form of a memorandum of understanding. And with that memorandum of understanding, you will be able to see the Strait of Hormuz open. Remember, that's the whole concept. The markets are a very cruel mechanism of distinguishing what is important and what is not important. The market, in all honesty, it might sound really, really bad for me to say this, but the market does not care about the number of Americans that died versus the number of Iranians that died. What it cares about is whether free flow of trade goes through the straits. That's all that matters. If there is free flow of trade and free flow of oil that passes through the Strait of Hormuz in the next 30 days, in the next 15 days, inflation will start heading lower. If inflation starts heading lower, you will start seeing the possibility of these rate hikes that we've been looking at all throughout in this memo that you can see here, where we've been looking at these chances of rate hikes coming through. These might not happen. Now, if they do not happen, the only reason they don't happen is because inflation heads lower. And the market moves from a rate hike scenario like what we saw for the 9th of December, where the probability of a rate hike is more than 50%. If we drop back there, back to zero, and we stick to a no rate cut, no rate hike scenario, the market only then cares about earnings, which have been growing faster. Which is why I keep giving you this example here where Strait of Hormuz opens, crude prices collapse, and they would then likely fall back to the $60, $70 range, which it was before. Remember, if you study history and you look at wars and you look at the way oil and stock prices have acted, when the war ends, oil prices usually go below where they were even before when the war began. So when the war began, oil prices were at 65. You can see oil go below 65. If you have some form of a memorandum of understanding, you have some form of an end to this war. Hostilities don't seem to be coming back. They can have their nuclear discussion for years to come. The market does not care about that. Free flow of trade, ships moving through, oil moving through the straits, and prices of oil collapsing, inflation expectations and inflation dropping, the Fed will start looking at it as inflation being transitory. If that happens, the sector that is lagging the most, which is the XLF, which is the financial sector that I shared here, will be one of the first ones to react and possibly take out 56 and might just have the next 12 months where it could be heading towards the 60, 65. Now, remember, none of this is investment advice. This is just me giving my thoughts that you can read in this memo. So please don't make any trades based on it. But if you had to position yourself, what would you do, right? So look at a company like SoFi Technologies. This company had a guidance of growing in the mid 30s. In the current quarter that came out, this is a guidance that they gave of growing at about mid 30s. So let's say 35%. They grew their revenue at 41%, but the stock still fell. Now, why did the stock fall? Because the market doesn't care about the earnings that just came out. The market cares about the next 6-9 months where the earnings are going to be coming out. And in case you have these kind of a move where you are seeing rate hikes, then these earnings of 41% would not be coming through in the future is what the market is expecting. So if you had to position for a reversal where the Strait of Hormuz opens, and let's say you believe that's the case, just the way I do, then you might be sitting on a stock that has fallen all the way from $32, which was there earlier this year. Let me actually show you the chart. So this was $32 right around November 2025. And today it's at about 15. Even with great earnings at 18 to 20, it fell all the way down to 15. And it's still playing around there. This stock is not reacting to its earnings, it's reacting to the Fed rate hike expectations. What happens under a scenario that the reversal takes place, and what I've explained to you plays out, where you have a reversal, it does not take very long for this stock to start moving back towards the 30s. Let me give you a simple example. I'm just going to try seeing if I can show you this. There you go. This is when we had a move all the way from 15, which is on 13th of June, to November, right? So that is July, August, September, October, November, less than 6 months of a move, and the stock doubled. In this period, there were no inflation expectations picking up, no rate cuts, rate hikes, none of that scenarios was playing out. There was just a possibility that we would possibly in 2026 have a rate cutting schedule rather than a rate hiking schedule, which might come back if the Strait opens. And if that happens, these stocks can go up within 4 or 5 months, they could be up about 50 to 100%. Now, I'm not saying again that would happen, but I'm saying if you can plan the way you trade or the way you invest based on how the market would react post 3 to 6 months from now up until the next 20 months to 30 months, that is where you make money. It's not what's currently happening that makes you money. It's where and how things are moving towards that makes you money, right? So this is one of the videos that I wanted to make to basically explain the memo that's come out, in case some of you like a video rather than reading an entire article here. But also a disclosure, we may or may not be holding it. As of yesterday, we were. So you can go ahead and have a look at this memo. You can go ahead and look and have the website as well. If you have any queries, you can then just inquire right out here. You can send us an email. We'll be glad to reply as well. Any questions you have, that'll be great as well. I'm going to put the links of the website as well as the memo on the YouTube description. So that's that. Let's all hope for this war and the memorandum of understanding to basically come to some form of resolution, get the Strait of Hormuz opening, get the price of oil going lower, and then you could have maybe even a melt up scenario in the American stock market and maybe stock markets globally. You might have a big boom in equity markets over the midterm period. The next time, whenever I do, I would like to explain to you guys about how the midterm elections happen, what happens there, and the effects of it on the stock market. But until then, thank you so much for watching this and have a good day.